Get ready for a new episode of KP Talks Dollars and Cents. Learn financial literacy and get real-time updates on all things housing, finance, and real estate with your host, Kevin Perenio. As an owner and C-level executive for 20 plus years in finance, KP is here to serve you with all of his knowledge and experience. Whether you're a broker, realtor, or just interested in the economy, this is the podcast for you. So let's get started. Here's your host, Kevin Perenio.
Hey, it's KP coming to you live from Corona, California. Well, my damn Longhorns lost to the U. So anyway, 4 teams left for all those that care about March Madness. The Final Four, hopefully your bracket's still intact. Something like a quadrillion, 1 in a quadrillion to get all the games correct. A perfect bracket. Anyway, damn Longhorns went cold the last 6-7 minutes. Couldn't even shoot. So what's going on here? I saw a pretty cool quote. I want to read it to you. The future is only allowed to happen at all because the elite didn't see it coming. So think about that. You know, we have a political elite. We have the financial elite. We've got millionaires and billionaires that get demonized by politicians, and we're coming up on an election year. Think of the craziness that will be going on a year from now. Although I would trade political craziness versus 3 years ago this time we were kicking off the stupid pandemic. Can you believe that's been 3 years since that thing started? Gosh, I just looked. There's like 7 million deaths globally on the Johns Hopkins COVID chart and like 1.1, almost 1.2 in America. Unbelievable. Seems like forever ago. Anyway, but you know, you're talking about the political elite and the financial elite. And, you know, you saw this run on this bank that happened that obviously the elite didn't see it coming. You know, they would have protected themselves, protected their assets. But one group of financial elite did see it coming. And that cohort at Silicon Valley Bank, the second biggest bank failure in American history behind Washington Mutual, was basically a group of, venture capital money. $40 billion, $42 billion left in deposits in a day. And unfortunately, they've been under attack. And again, I'm not trying to get anyone to, have sympathy for millionaires or billionaires. That's not the whole point. But, when you constantly have political elite and figures in the government, people in the Senate and Banking Committee saying, pay your fair share, millionaires and billionaires, and villainizing them. And literally the people that create, PayPal and Meta and Uber and all these things and all these jobs and, 750,000 jobs created at Amazon, and you have all this money that backs up these companies that creates jobs, but then they get, vilified in the press by the political elite. They are going to move their money. They are going to protect themselves. They are in survival mode. And, the bank didn't see that run on the bank coming. And so deposits have been moving. And if you didn't see my video last week, there are 4,200 banks in America, and the top 10 have 50% of the assets. The top 10, not the top 10%, 10 banks have 50% of America's assets out of 4,200 banks. Again, we're too big to fail. But these elite, money centers and these elite classes that set policy, that set, fiscal policy at the Fed, this elite, obviously there are unintended consequences with some of these policies, and there's still some uncertainty. So is the bank crisis over? I don't know, but I got to give some more props to Chris Whalen. He writes the institutional risk analyst and Whalen Global. He was on CNBC today. I saw a clip of him today talking about, this risk of duration. He's been talking about duration. So when we had quantitative easing, the Fed was printing money, basically, issuing more debt, right? More treasuries. They were buying, selling to open mortgage-backed security positions. And so quantitative easing, and if you saw on LinkedIn today, you can search around after you see my 10 minutes of rambling here, 2 15-minute parts. Brian Zitten at Rigora did a good job as CEO of Rigora, appraisal tech that we use at PRMG. We love it. He had Brian Wilkie on there explaining, a lot of the mechanisms of what the Fed does with their operations. The difference between quantitative easing, like how we saw from 2020 and until about a year ago, when they were putting liquidity into the system, growing the money supply with no cap, on duration. Now it's interesting because when you have treasuries and mortgage-backed securities, you can hold these securities until maturity and make your revenue as they go. But if you have to market, which is what Chris Whalen has been talking about, then those things are not worth as much money. You have to take a loss, maybe 20%, because people aren't, they don't want to pay for a 3% mortgage-backed security when, the going rate up there is the coupon's 5.5, So those lower yielding interest coupons in securities, if forced to market like Silicon Valley Bank had to do to shore up their assets because they were having a run on the bank as deposits were leaving, they took losses. And that just exacerbated the run. That was a crisis of confidence. By the way, consumer confidence report comes out in the morning. So duration risk is still out there. We don't know who's going to have to mark these securities that they're holding for maturity to market at some point when there's a need arise. We don't know what's coming. I don't know if it's a black swan event. I can't say there's systemic issues, but the Fed sure seems to think that they shored this thing up. So Citizens Bank, which by the way bought CIT and also bought First Franklin for those on the mortgage side, they own that mortgage arm. Citizens Bank just was the winning bidder in an FDIC, the Federal Deposit Insurance Company, the FDIC, which has $120 billion trying to backstop losses for our 250,000 or under deposits or any banks in the system that may lose money. In this 2-week bidding process, Citizens Bank won the bid of the assets for Silicon Valley Bank. So now they'll have more branches, they'll have more wealth management, they'll have everything except actually the treasury assets. So $20 billion loss to the $128 billion FDIC Insurance Fund. And so all the remaining banks out there over the next couple of years will have fees that they'll have to be paying, about 3% of their profit over the coming, let's say, 5 years, that they'll have to be replenishing this FDIC fund. So, I guess the fund is there to do its job, right? So, I'll get into some more stats on that in a second. By the way, we had an awesome meeting last week, in case you missed my update, for the California Mortgage Banker Association. I'm on the board of directors. Think that whole group was a great experience in Sacramento. The California Mortgage Innovators Conference is coming up in Anaheim. And so if you want to be a sponsor, this is a technology show, a tech showcase show. It's based in California, which obviously is a tech hub, and 25 to 28% of all mortgage lending is done in the state of California. It's a big show. So if you want to be a sponsor, I recommend it. It's usually really well done. It's in Anaheim. You can make a Disney vacation out of it through the weekend, bring your family. It's in May and late May. So, come on out. It'll be pretty cool. All right. I think it's around June. I don't have the exact date, but anyway, look it up. I think it's around Father's Day weekend, if I'm not mistaken. So, June 14th, 15th, I believe. Okay. Now, by the way, I brought up consumer confidence. We have a PCE number coming out on Friday. That, I believe, is the is it the PCE? Let me consult with Robbie Chrisman, Rob Chrisman's son, which, by the way, Rob Chrisman is on the board of the California MBA Board of Directors. Had a great chance to break bread with him last week. We are going to get some data this week. We are going to have the PCE, which is a producer consumption expenditure number. It's one of the Fed's favorite measuring tools. That's coming out. So thank you, Robbie, for lining that up there. And he said something pretty interesting, that some more Fed recap here, that the additional firming may be appropriate versus previously saying additional firming will be appropriate. Now that was seen as, we might be done with Fed rate hikes. It was interesting. Steve Leishman from CNBC asked Chairman Powell about that, and he said that the focus should be on the words may and maybe firming. So some and may. So he was kind of trying to make some emphasis. By the way, Elliot Eisenberg, the Bowtie Economist, is on Mortgage Pro's 411 tomorrow, so check that out. and he's had a couple good updates lately. In a move largely anticipated, the Fed boosted by 25, and he also mentioned ongoing increases in target rate with some additional policy firming may be necessary. So he brought that statement up as well. Some and may. And of course, he talked about the insurance fund with the bailout. So lots going on, some fallout here. We'll get into some more of the data later this week, and have a great one. Cheers. Hey, it's KP coming to you live from Corona, California. This is one of the earliest videos I've ever done for you on a Thursday night. So it's end of the quarter, end of the month. This year is 1/4 over, and we've been hustling to try and get this spring purchase business out the door. A little bit of a false start here at spring purchase season. We had a little spike up in rates, which affected locks, late January into early February, which kind of trickled into fundings. But happy to say that our company is up in fundings and locks, and things are looking very promising for next month as well. And I'm sure it is for everybody. All ships rise to the tide, right? The Freddie Mac rate just came out, the average Freddie Mac rate, and it came down a little bit to 6.32% on an average 30-year fix. I think it was 6.38 last week, according to 6.42, excuse me. According to watching Robbie Crispin, that's Rob's son, and his cap market section of the Crispin blog. And the Mortgage Banker Association, I go to MBA.org, and I go to the newsroom, and I like to read the articles there. And they talked about loan applications being up. So pretty cool stuff. Quick little look and see how the CME is thinking about the Fed funds future rate. They still think there's going to be no rate hike May 3rd. And that's interesting because, we're at 4.75 to 5 on the terminal rate right now with the Fed on their last rate hike. And there's a 47% chance that they won't hike rates. Just the other day on Monday night, it was 58% chance that they won't hike rates. So now it's 52.8%. This is a CME tool, so you can go to cmegroup.com and you can look up the Fed Funds Future Tool. So it's a pretty cool way to sit there and go, what does the market think day to day, minute by minute, by trading futures on where the Fed is going to take their action? So why did it go up? Why do they think there's going to be a quarter raise on the next meeting, which is May 3rd, which, by the way, the next meeting after that is June 14th, and the market currently thinks that they're done after this next one more quarter raise. And I happen to agree with that, even though just a couple days ago, the Fed Fund Future Tool is saying there was a 58% chance there'd be no raising. Now, that was a little bit of fear and trepidation coming from all the bank fallout, all the stuff with, a couple banks in our country failing and having to be shored up, and some saved. $20 billion hit to our FDIC Insurance Fund. I guess it did its job. There's like $100 billion in mortgage-backed securities just between Signature Bank and Silicon Valley Bank sitting there waiting to be sold. They're in receivership of the FDIC. Hopefully they don't sell it at a bad price, because all of us holding, for maturity, holding our portfolios, the price, if we were to put it on the open market, now has a lower comp. It's like if your neighbor just fire sold the house and crushed the value on your street because they had to get out of it for some reason. I don't know. They got to move. Someone died. There's a job, a divorce, whatever. You know the 7 Ds, right? Deployment, diamonds, diapers, debt, divorce. I like to say debt again after that. Downsizing and death. All these life events make people sell houses. Well, here was a life event. The extinguishing of life for two banks that were over-levered, and now they got to fire sell an asset that we all buy and sell. Remember, the secondary market is cold, heartless, and unforgiving. We buy and sell money backed by a home and a bar making that payment. And whatever people pay for these assets when they're sold in the open market is the price action. And so it'd be interesting because it might force a lot of people who have not sold mortgage-backed securities in their portfolios, their MSR, mortgage servicing rights, MBS, agencies sometimes are called. It's like, just one notch below the flight to safety of a treasury. But price action, whether it's the stock market, bonds, futures, your house, gold, the price is what people are willing to pay, supply and demand. So right now, after seeing a couple banks fail because they got over-levered with mortgage-backed securities and treasuries, you think other banks are in a hurry to buy more mortgage-backed securities? So there's going to be a fire sale, potentially. And it will be interesting how that impacts independent mortgage bankers and banks and their balance sheets. Now remember, we could hold to maturity, which means we could market whatever we think it's worth based on the value of the servicing, paying us little bits here and there, 25 basis points a year minus your servicing cost. Let's call it 4, 5, or 6 basis points. You can hold that. You could say it's going to last 6, 7, 8, 9 years. Some people are saying these 3% rates are going to last for 11 or 12 years. It's all kind of funny money, right? Until you got to sell it. So mark to market versus hold to maturity. Think about that. Okay, enough of that. Big inflation read tomorrow. The Fed's preferred inflation reading, the PCE. Now, I was so tired and exhausted on Monday night. I apologize. I totally fumbled my words. Personal consumption expenditures. It is more of a live, real-time, what people are paying for stuff, goods and services. And there's a little bit less weight on housing than there is in the CPI data report. Nevertheless, this is one of the Fed's preferred measures. It's called the deflator, the Fed deflator. What are people paying last month for expenses? What are they paying? Look, there's a lot of components in here. We all know that services, people paying for dinner and travel and leisure and going out, and it's expensive right now. And people are still doing it. Hell, there's $5 trillion in cash sitting in money markets right now. Cash on the sidelines. People have nested equity. They've got equity in their homes. So people feel rich. You know what? Some things are getting less expensive, more expensive. Maybe eggs have come down. Wheat has come down. People are traveling as much, so oil and gas has come down. So, there's these little pockets of where people spend that are rolling up, down, up, down. What's not rolling is that 3% mortgage we all did a year and a half or a year ago. That's a fixed payment. If you're not a homeowner, now you know why. You fix in that payment, you get low rates, you fix your shelter cost. So now you got all this extra money. Maybe you switched jobs, took a higher paying job. Wage inflation, remember the wage price spiral? We've been talking about that. Got a little extra money because you fixed your housing costs. So you got all this stuff over here. Value of your home's going up. Eggs are coming down. Gas is coming down. I'm going to go out. Go out for dinner. I'm going to spend more money on leisure, hospitality, travel, those expensive airline tickets. And it might show up tomorrow with maybe a little bit higher than expected inflation read. The Fed's watching. There's more data coming out. There's another PCE read and CPI print coming out before the May 3rd meeting, so we shall see. Q4 GDP, our gross domestic product, is based on consumer spending, which is why the consumption expenditure is a very important aspect, the Fed's favorite. 70% of our economy is based on consumer spending. So how was GDP? Well, Q4 came down. I saw that Robbie wrote 3.2%, 3.4%, something like that. I'm sorry, 2.7% for Q4. Now, some of the Fed, whether it's Jeremy Siegel, professor at Wharton, whether it's Robbie Chrisman, whether it's Dan Habib and Barry Habib talking, there's a very interesting point. I've been hearing it for a little while, but I just want to accentuate this. The Fed thinks that our GDP for the year will be 0.4%. Now, if right now we're at 3.2% for Q1, okay, how bad do the next 3 quarters have to be to bring that average down to just 0.4%? It's a negative 2.8% on average the next 3 quarters. So are things going to fall off a cliff? I don't see them falling off a cliff unless we lose jobs. And when you lose jobs, you have borrowers that don't have wages to then pay for goods and services to keep inflation high. So until that cracks, which it hasn't yet, which we just saw, weekly jobless claims every Thursday, weekly jobless claims came out today, edged a little bit higher, went up about 7,000 to 198,000 new claims, continuing claims, 1.7 million borrowers are continuing to have jobless claims, means they have not found a new job. That labor market we're watching, is it going to stay stable? Will it hold up? Is that what a soft landing looks like? Is anyone even talking about a soft landing? No. So I'm bringing it up because no one's talking about it. It's not off the table. And by the way, tech stocks are rallying. What's up with that? I'm not responsible for your losses, only your profits. I'm not a financial advisor, but it's very interesting to see this rolling recession. Let's make sure we talk about that going forward. There are certain sectors Commodities, recession. Okay, your manufacturing, going down. Housing, we're getting blown out, right? But, technology, maybe they did their layoffs. They got their cost structure right. Technology is deflationary. We are going to see in the next couple weeks when Q1 earnings season starts in earnest. Have a fantastic weekend. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.